How's everybody doing today? Welcome back to another episode of The Banker Next Door. I am your host, Dr. Joe Berquist. Today, I wanted to talk to everybody about doing a capital raise. There's basically only two ways to do a capital raise, either debt or equity. And so I saw a great article in Bank Director basically looking at the question of is your bank in a great position to raise capital and then use that capital, deploy that capital, if you will, to take advantage of opportunities that may arise in the marketplace? So let's take a look at this article here. And this is called Always Have a Plan in Place for Raising Capital, Having a Blueprint for Selling Stock, Your Equity, or Issuing Debt can position banks to respond more nimbly to the 2025 M&A marketplace. Now, before we get into this, I just want to say that what are the reasons why, primarily, why does a bank have to hold capital? Well, there's basically four, I think, primary reasons. Number one is regulatory requirements. Basically regulators require banks to hold capital, and they have to have a certain level of capital. So there's a number of capital ratios out there, but let's just use what's called the Tier 1 equity capital ratio. Now, a regulator might, like to say the OCC, for example, would basically say that any bank with more than 5% in Tier 1 capital, Tier 1 regulatory capital would basically be considered a well-capitalized financial institutions. Now, most banks today are going to hold far more than that. Most banks today, and I think the industry standard is basically 8%, like 8% Tier 1 capital ratio. But again, a lot of banks like to hold even more than that. A lot of your best performing banks probably have 10, 11, 12, 13%. Tier 1 capital equity. And the reason why they have that equity is for a couple of other reasons other than simply regulatory requirements. Number one is to protect against write-offs in your loan portfolio. If you have credit quality issues, you have to take write-downs. Well, you need capital to basically cover those losses. That's one of the things. Like if you have earnings, you have loan loss reserves, but then you have capital. So capital is a buffer there to prevent in the situation you have deterioration of your loan portfolio and you have to write some loans off. But then why else do you have collateral? What else do you have capital? Well, you have capital to take advantage of the market. In other words, you want to grow your bank. So, you might have a recession, and the bank might sit on the sideline for a year to 18 months, waiting for kind of the dust to settle or things to go. And they have plenty of capital sitting there to say, hey, when the moment's right, we're going to kind of explode out of the gates, and we're going to be in a great position to lend money where maybe a lot of other banks in the local marketplace are they're kind of hamstrung. They're kind of stuck. They're like, yeah, we really don't have the capital to grow. So first and foremost, being able to grow the future earnings of the bank is another major reason to have capital. But perhaps a fourth reason is you want to be able to take advantage of M&A. If you see a opportunity arises and you have something, you have a target, maybe a bank that your bank has been looking at for a long time, and they want to jump on that opportunity, and so you got to have the capital there ready to go, or you got to be able to raise that capital very quickly in order to take advantage of that. So like I said, I needed to put that out there just to give everybody a little bit of context for some of the reasons why it's so critical and important for a bank to have capital. Obviously, future growth, the potential to take advantage of an M&A transaction. These are major reasons why a bank needs to have a very strong capital position. So, but like I said, let's take a look at this article real quick. So as the M&A market shows signs of a significant bounce in 2025, more institutions are considering their capital levels and whether they need to prepare for a possible offering. So one significant factor that may lead to a surge in capital raises is the flurry of subordinated debt issuances in 2020 and 2021. During those years, financial institutions issued billions of dollars of sub-debt in public and private transactions. In in general, the debt was structured as a 10-year fixed to floating instrument, with the yield fixed for only the first 5 years. In an historically low interest rate environment at that time, banks were able to issue subdebt at extremely low yields. We had some clients issue the low 3% range. In the next 6 months, these debt instruments will begin to reprice substantially higher given the current rate environment. So yeah, those things might go to 7-8%, interest of what, in other words, this is what the bank has to pay out to basically the creditors that are the borrowers rather are holding that debt. So one third party estimated that by the end of 26, approximately 65 billion of subdebt will reprice. To refinance their outstanding debt, banks may consider an opportunistic capital raise either by selling common stock if pricing is advantageous, or by issuing preferred stock or subordinated debt if the Federal Reserve continues to lower interest rates and investor appetite exists. One challenge for another round of subdebt is that bank holding companies were active investors in their prior issuances. That may not be the case this time around. In addition, we are seeing institutions raise capital to help restructure their balance sheets, primarily to sell underwater bonds and to redeploy those proceeds and any excess capital into higher yielding securities. So banks are also repaying outstanding balances under the Federal Reserve's Bank Term Funding Program and other high cost borrowings. And then although many banks are repositioning their balance sheets in this manner slowly over time without raising capital, it may be prudent for a board of directors to evaluate whether a large one-time approach similar to the one taken by some banks to deal with problem loans during the financial crisis is preferable. So financial institutions should evaluate their capital needs and be prepared to take advantage of market opportunities. We recommend that institutions proactively evaluate their capital stack, senior and subordinated debt, preferred and common stock, tier 1 and tier 2 capital needs, debt to equity levels, and update their capital plans as appropriate. Consider what communications, if any, should be had with the banking regulators prior to a capital raise. Seek the input of a financial advisor to have up-to-date information on the markets and the institution's options at any given time. Assess the potential sources of capital, whether it would be around the board table, existing shareholders, institutional investors, or broader offerings. Evaluate the institution's incorporation documents to confirm there is a sufficient number of authorized shares of capital stock for a potential raise. If not, consider seeking approval for an amendment at the 2025 annual shareholder meeting. Evaluate any contract, regulatory compliance, or lending issue that should be cleaned up prior to any offering. Consider the due diligence and disclosure obligations that may factor into these decisions. If the institution is registered with the Securities and Exchange Commission, in other words, if it's a publicly traded institution, confirm whether a current shelf registration statement is on file, that it hasn't expired, and that it has a sufficient dollar amount of securities registered for a potential issuance. Being prepared for a capital raise will allow banks to move quickly and efficiently in response to market opportunities should the need for additional replacement capital arise. This preparation, coupled with proactive planning for the institution's possible participation in the developing M&A market, will provide an institution with maximum flexibility to react to the environment in 2025. So that's a really good short assessment there, but there's a couple of things that we need to talk about in here. And again, I could talk about some of this stuff for hours. I mean, you can get really in the weeds on some of these things, but I'm going to keep this very high level. So just some things I want people to understand about. So we started off the article talking about how a lot of banks basically issued subordinated debt in 2020 and 2021, and how they did that at very low rates. And now how when they go to reprice or basically roll that debt over, they're going to have to pay much, much higher rates, and that's not going to be very attractive. So if you're a bank and you're out there and you want to raise capital and you're looking at your options, either issue debt or issue stock, or stock or equity, you're looking at these options, you're going, well, if I issue debt, it's going to be very expensive because I'm going to have to pay much higher interest rates than I was a couple years ago. like I said, that may get a little bit more attractive if the Federal Reserve continues to decrease interest rates. I may be able to, I may be able to do something at, maybe 5%, 6%, depending on how much rates get brought down here over the next year. So that could become a little bit more attractive over time. But right this minute, that's a very expensive option. Option number two, issue stock. Why would a bank not want to issue stock? Because you're going to dilute the existing shareholders. Again, for most smaller banks, the board of directors is going to own most likely the majority of shares. Now, when you look around at people that you could potentially sell to, the first thing I think a lot of banks are going to do is they're going to look to their existing shareholders and they're going to say, hey, listen, we want to do a capital raise. Say we want to raise $5 million. Do we have enough juice amongst our existing shareholders that they'll just buy the stock? And now, why would you want to do that? You'd want to do that so that you're not diluting them as much. Okay. But if they don't have if they don't have enough bandwidth there, so to speak, to raise that $5 million, now the next step would be, okay, let's look at bringing in some new shareholders, and now the new shareholders get brought in, you're going to be somewhat diluting the original shareholders. Maybe not super attractive for them. Depends on kind of the situation of the bank and what you're looking to do with the money, why you need the money. If it's for future growth or for an M&A transaction, that probably be a good thing long term. But if you need it just because, like I said, you got to reposition your balance sheet, you just need the money, you need the equity, the capital to stay afloat, that kind of thing, then that may not be so great. Then the third option would be, okay, now let's go look at institutional investors. And that gets to the institutional investors. That whole thing can get a little dicey because, they start buying a large chunk of your stock. That can also signal to people too that, you might be, if you got institutional investors buying your stock, usually at some point, those institutional investors want a pretty nice return, which, you could end up, maybe unintentionally putting yourself in a position at some point down the road where they might start pressuring you to sell the bank. And again, a lot of smaller banks, they don't want to get themselves into that position. So this can get a little, tricky. It can get a little tricky depending on the market and what's going on there. And so I think in this article, they offer some really good advice about basically, understanding, evaluate your capital stacks, evaluate for a debt and equity position. What are your tier 1 and tier 2 capital needs? What are the debt to equity levels of the bank currently? And then update your capital plans as appropriately. And then, just things to think about, like if you're going to raise stock, then and if you're already publicly traded, then you need to make sure certain things are in order. If you're going to issue debt, again, you need to understand, are certain things in order. Again, the same principle. But it is interesting to kind of consider the whole loan aspect of this, right? Like it's kind of the same thing with loan issuing debt is kind of the same thing, the loan situation, right? You may have a borrower that you made a loan to 3 years ago, 4 years ago at 3.75%, and now their debt's matured. You got to roll it over into say another 3, 4, 5 year note, and now the rate is much higher and they might have some cash flow issues with that, and it's kind of the same thing with the debt issuance. Banks issued debt, 4 or 5 years ago at really attractive rates in the threes. Now they're coming back. They got to now roll that debt over. Same thing as their borrower on the loan side. They got to roll that debt over at a much higher rate. Might be a little tough for the bank, might squeeze the bank a little bit in terms of what they have to pay out to get this capital. So, so again, a lot to think about, a lot to evaluate there. But like I said, I wanted I thought this was a great article at just pointing out, I thought it would give me a chance to kind of explain capital a little bit, like why it's important, why banks need it. Why banks may, what opportunities it can afford banks, and then how they can kind of get that out there. I will do some future episodes here that are going to be more in depth on capital at some point. I'll explore that topic a lot more in depth. I I did an interview episode with Chad Hall, who's an investment banker for Janney Montgomery Scott here in my local area, my local PA market. I would love to maybe have him come back on and kind of talk about this in depth, because this is his absolute expertise. So like I said, I will definitely look to try to do that in the future. But like I said, I hope this was good. I hope people kind of learned a little bit about the capital raise and why banks need capital and why it can get a little tricky. It's not as easy as just kind of flipping a switch and saying, oh, hey, we need the capital, go get the capital. It's a little bit more complicated than that. But like I said, if you like this episode, please make sure to like, share, and subscribe, as that always helps the channel. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please be sure to leave your comments down below, as I always love getting back to everybody. Make sure to check out some of the other content on the channel, and I will be back to everybody again real soon. Thanks a lot.